Welcome back to this channel. This is Unfiltered Forex with me, yours truly Clement. And this video, we're going to break down the NFP report, which you got yesterday on Friday. When was it? 4th August, yes. So, first you remember the non-farm payrolls number was below the estimate, and there was a revision also. There were two revisions, in fact, and also the average hourly earnings, private non-farm payrolls, government employment, unemployment rate. We're going to look at all that in a bit. First, I just want to talk about. Okay, first, I just want to say I'll first look at the pre NFP analysis. There was a forecast. I usually do this forecast, as you can see here. That this is a thread in my Discord server where I purposely do NFP forecasts. Like before the release, I come and say what I'm expecting for this time, and yeah. Okay, so this, as you can see, the date August 4th. This is when I started. It was 1 a.m. 1:30 a.m. I barely sleep, so yes, this is why I did it at this hour of the night. Again, this week, we've gotten all major releases we need to make an accurate forecast of what to expect later today in the NFP report. And this is a summary of the events we got the week, the major ones: the ISM manufacturing PMIs, the JOLTS job openings, ADP non-farm employment change, and the ISM non-manufacturing PMI, or the services PMI. These, of course, and also the jobless claims. We're going to first look at this forecast, then go to the actual data, then go to the breakdown. I started with the ISM reports, and as usual, the focus is on the employment index. The services sector grew there was a decline from 53.1 to 50.7, 2.4% decline. The manufacturing sector, there was also a decline, but there was a bigger decline here, 48.1 to 44.4. The decline was by 3.7%. And these indices in the manufacturing PMI indicate contracting. The employment situation in the manufacturing sector is contracting, meaning there is more firing than hiring. But in the services PMI, there is still more hiring than firing. Yeah, this is what we have. Okay, let me just go. For the month of July, both the manufacturing and services sector slowed down on hiring. The manufacturing sector especially is where the biggest decline was. The index is at 44.4, below the previous 48.1 reading, and of course below 50 to mean the employment situation in the manufacturing sector is slowing down fast. The services PMI, however, employment index is still above 50, meaning there's still more hiring than firing in the sector, but the month-over-month decline of 2.4 means hiring has reduced. So far, these two pieces are pointing towards a softening labor market. This time, we were lucky that both the services and the manufacturing sector were showing data that is in sync with each other, meaning you can see they were both declining, which is kind of good. We got a bias from that. Okay, then let me continue. Other than that, showing softening labor market, there is also the job openings data, which was released earlier this week. Interesting numbers. There was a revision. First, we need to highlight that the previous month's data was 9.8 million, but it was revised downwards to 9.616 million, and the current data for the month of June was 9.5 million job openings. So these numbers show labor demand is falling, and this revision shows that last month there was less labor demand than announced. Of course, that supports the narrative shown by the ISM PMIs that labor demand is kind of falling. Yeah, labor demand is falling steadily, and this is usually reflected in the jobs numbers. Yes, these job openings numbers, they are very important when you want to determine or to get an idea of what to expect in the NFP numbers, job openings, labor demand, very important. And then it also supposed to tell you to watch out for revisions when the NFP drops. As you can see here, if these job openings have been revised lower to show that there was less labor demand than initially thought, and this data, Jules, I think it's also released by the BLS. Yeah. So yeah, that was automatically an indicator to tell you to watch out for revisions in the NFP. Meaning, even last month's data, there was a likelihood that would be revised downwards. This was last month's release. There were two revisions downwards, and they were major contributors to the move we saw on that day. Yeah, this is a screenshot from the previous NFP breakdown of the previous month, and here we see the change in total non-farm payroll for employment for April was revised down by 77,000 jobs from 294k to 217k, and the change for May was revised down by 33,000 jobs from 339 to 306. So, yeah, and there's a summary here. Let me pull this up. Yeah, April 253k, May 339k. These are the original figures, and then after the revisions, we got April 217k and May 306k. You can see these revisions are mainly being revised lower to show that the labor market is softening faster than the market previously thought. And there's a link here. Let's just look at it. Yep, this is where I was during that time when I talked about the revisions only coming lower than actual reported number. That's enough to say it's pretty much the same with what I was talking about here. So this is the forecast, remember? And this time also, it was likely that last month's number might also be revised downwards, and that's something you have to watch out for. This time, the estimate for NFP is at 200k. Yes, as you remember, last month's data was released at 209k, and the previous month's data was revised downwards, and even the previous month's data for May, you can see here I cancelled it out, was also revised downwards from 294k to 217k. Of course, this part was not updated on the website because of they only update the previous month's revision. Now, before we come to that, looking at the jobless claims data, this is where things aren't adding up. Now, this jobless claims data, don't worry about this line. This is just me comparing the first week of June to the first week of July, second week of June to the second week of July, third week of June to third week of July. It's just comparing that weekly number. And yeah, as you can see, you don't even need to do a lot of math just by looking at it. You can notice that the jobless claims here were significantly lower than these other ones, meaning there were less unemployed people in the month of July. And yeah, that means there are less unemployed people than there were in June. Automatically, that screams trouble for the unemployment rate. Yeah, this might be one of those months where the jobs numbers are softening, but the unemployment rate is at historic lows. And you remember that's what we saw. So, still on the forecast, when this data piece in particular isn't adding up, this jobless claims data, it makes it kind of all the more riskier to trade the news because the possibility of a whip or indecision in the market does suppress move. But I didn't want to go too deep into that. Yeah, but otherwise, all factors considered, the data is pointing towards the softening labor market, except for that jobless claims data. That was the only one pointing to strength. Yeah, this time I did not talk about the ADP mostly because it was similar with the PMIs. They were in consensus. They were in sync. Slowdown in both sectors, but hiring in the manufacturing sector is of course slowing down faster than the services sector, and the services sector is still showing strength, but also slowing down. Clean setups, of course, on euro and gold. Yep, and this was the outcome. The outcome came out just as I expected. The non-farm payroll number was below estimate. This the jobs number was softening, and there was the previous number was revised downwards. As you can see, let me put this back. The previous month's number was revised downwards. This number means there was a revision. Here also on the private non-farm payrolls, the number was revised downwards. Yeah, the number from the previous month was revised downwards. But when it came to the unemployment rate, it was lower than the estimate and even lower than the previous number. Because as we have seen from the jobless claims data was showing that there are less unemployed people in the month of July, and that's why there has been a downtick in the unemployment rate. Yes. Looking at the average hourly earnings, 4.4%, same as the previous one, but higher than the estimate. Average hourly earnings month over month, same as the previous one, but higher than estimate slightly. These ones you can kind of ignore them for now. It was mostly good news for the market. The main concern was the payroll number, the revisions, and the unemployment rate, of course. Now let me look at the breakdown now of the NFP itself. Still in my Discord because this is literally my journal. This is where my work is. Here, when did I start? Oh my goodness. Yeah, this is where I started. So this is what we got today. Here's the NFP report itself. Let me see if I can pull that up. Yeah, this is the NFP report itself, and yeah, this is it. Now let me go back to the breakdown. Yes, this is where I started the breakdown, and I started by looking at the revisions first on page 3. It's usually on page 3. The change in total non-farm employment for May was revised down by 25,000 jobs from 306k to 281k, and the change for June was revised down by 24,000 from 209k to 185k. With these revisions, employment job, blah blah blah. Yeah, as you can see from here, after the revisions in the June report, May jobs numbers was, let me use this tool. May 306k, June 209k. After the latest revisions, May it's 281k and June 185k. This tax is from the previous analysis and breakdown. You can see the April numbers were revised from 253k to 217k, and the May number was revised from 339k to 306k. So you can see at the end, the May jobs data ended up being 281k, a big revision from the initial 339k we got in the month of May. No, in the month of June. Yeah. And in general, you can see these numbers are pointing towards softening and a very softening labor market, which is of course what the Fed wants to see. That Jerome guy, this is the kind of soft landing scenario that he wanted to see. A decline in the jobs numbers, and yeah, these revisions are only showing a softening labor market, but the BLS is purposefully releasing this lagging data. Yeah, I don't know if it's for political reasons or for some other random reasons, but usually this is what government agencies do. They release, I don't know if I should call it misinformation, but they purposefully release data that will fit the current narrative of the market, then later come to revise that data to show something, now to show the clear picture. As you can see here, the May jobs report was initially at 339k, but after all these revisions, the May number is 281k. So these numbers, yeah, these revisions combined with the below estimate reading we got yesterday, are all showing a soft landing scenario. Though the unemployment rate is still very low, these softening hiring numbers will eventually materialize into an uptick in the unemployment rate. Well, at least that's what the market thinks. And ultimately, that means the Fed might not have to raise rates again. So this is ultimately good news, especially these revisions. They are really feeding the bulls here because that means the Fed is less likely to hike rates come September. Because if we get the August jobs report on September and we get another revision even on the June number, maybe this might drop to 150K or 160K. I don't know. And maybe even the today's number, I don't might drop to, yeah, today's number was, this month's number we got was 107K, 187K, I mean, might drop further. I don't know to how much, but hey, those revisions, they're really going to affect the Federal Reserve's next monetary policy action. So that, of course, is bearish for the dollar. And considering the current market conditions, you can expect weakness in the dollar to persist for a while, most probably until next week when we get the CPI, and that's what's going to dictate the direction of the dollar index price action until the next big data releases. Currently, as you know, it's mostly unsafe to trade fundamentals on US stock market indices during an earnings season. That's why I'm only talking about the dollar index for now. Yeah. The US stock market indices, Nasdaq, Dow Jones Industrial Average, the S&P 500, those are my best indices to trade. I usually like trading those ones, but during such market conditions, an earnings season clashing with such big data release, it's not so good. It's not so good to trade that. And when we go to the charts, you're going to see exactly what I mean. Also, the incoming data, however good or bad it gets, it feeds two major sides of the market, right? Bad news raises the fear of a recession and the joy of a Fed pause. So yeah, like the low employment numbers, they are fueling recession fears and also feeding the joy of Fed pausing rates again and not having to hike again the rates. And it can be challenging to discern which is which. This is in the stock market scenario for trading the stock market. But for the dollar index, bad news means the Fed pause, which is bearish for the dollar, and even if it means an economic downturn, that's also bearish for the dollar. So yeah, it's the volatility is more likely to be unidirectional in the dollar index. That's why I mostly focus on that and treat the USD pairs more than stock market indices. Last thing before I concluded this analysis was, of course, the government hiring. This time, government hiring was only 15,000 jobs. Yeah. If you remember last month, this 57K number of government hiring really propped up the entire NFP number, right? If you remember, yeah, even in May, it was kind of the same scenario. These government hiring numbers are usually what prop up the final NFP reading. But this time, government hiring was low, and therefore, that's why even the NFP number was not too far. Yeah, the total private number was not too far from the actual number, the total non-farm payrolls number. So that's also something to watch out for. If government hiring is reducing, that's also kind of good news for the labor market currently because that means the labor market is cooling. That means the Fed might not have to raise rates again. Yeah, government hiring was the lowest we've seen in a while, and one of the reasons why this time we didn't get a strong total NFP number this time, despite the fact that private payrolls are a bit higher than the previous month's numbers. Now I'm done with the NFP breakdown, and yeah, this time, if you know how I do these things, I usually look at the Fed CME watch tool, but since we're working with general expectations, and for now the next FOMC meeting is quite far, I just don't look at this FOMC watch tool during such times. No, you just work with the general market expectation. You're going to get clear setups. If you're day trading, you're going to get market info, and it's going to be easy to decipher it without even having to look at the tool. Yeah, but as we get nearer to the meetings, as we get nearer to the date of the FOMC meeting, that's when it becomes quite important to keep monitoring the CMA Fed Watch tool. Yeah, now let me go to the charts. This is the US 30 chart, and as you can see, the intraday trend here was quite, let me use this pen, was quite flat. There was a slight decline until the hour of the NFP release. This is where it came, this first green candle engulfing the previous hour. This is where the NFP came, and yeah, the US 30 just pumped. And then the final hours of trading just corrected the whole move. This is why I highly do not recommend trading these New York Stock Exchange indices during this time, because these kind of moves, they are very common. They are very common when the economy is at the point it is right now. Remember, I said there's a fear of a recession and there's also the joy of rate cuts from the Fed. When those two market forces are increasingly becoming stronger, the moves here starts to look as messy as you can see here. But looking at the currency side, let's look at gold, for example. This is, let me switch to the daily time frame because there was a setup here. Yep, this is the setup. As you can see, it was an inverted head and shoulder pattern. Forgive my sketch work, but I'm sure you get the idea. That was the first, what's it called, right shoulder. But this is the left one. I don't know. Anyway, as you can see, there was a clear head and shoulder pattern, and I was waiting for the NFP move, the NFP volatility, to see where it's going to push price. The direction is going to push price in to confirm that this pattern is likely to be valid. So yeah, now I am expecting buys on gold probably to the 1980s level first. I'm expecting this price ring to continue to this level first. Let me do this one. Yeah, I'm expecting this price swing to continue to this level first. Then probably if the if the conditions align, the price might rally higher to refresh the all-time highs. It's likely, but we're just going to wait and see how the situation develops for this one. Another pair I should look at is the euro. Yeah, this is it. As you can see here, I had drawn a trend line here. I expected price to kind of bounce off the trend line from this point, but as you can see, that did not happen. There was a break of structure here, and price is now, I'm not sure what price is going to do next on this one, but I really think, according to the fundamentals, the dollar is going to get weaker, and this euro is going to pump, is going to keep rising for a while. Yeah, let me look at the dollar index. As you can see, yeah, this is the Friday of the NFP release, and I indeed was expecting price to just reverse from this point and continue falling. And we can see the NFP has been that catalyst to start off that reversal. Don't know if it's a reversal or a retracement, but it looks like a reversal to me. So we're just going to wait and see how next week is going to go, if this move is going to be sustainable, and before we get the CPI release, of course. So I think this weakness is going to continue for a while, and yeah, and just waiting now. On that day, of course, I on that day, of course, I did catch some trades here. It was really great. Was a really great setup, but yeah, going forward, I just have to wait and see what price is going to do, but I'm expecting this downtrend to continue for now. This is what I'm expecting. So that was it for this NFP analysis and breakdown. Going to meet next time. Yeah, just next week when I talk about the CPI. Yeah, forecast. Just going to wait for the weekly forecast video. I'm going to give something I'm expecting in the CPI. Done. I'm done. Have a lovely day.